traders, and it is Mark's first time joining us here on our Trade Thirsty Live events. So I'm going to go ahead and make him the presenter so he can load up his PowerPoint, and we'll do a quick sound test, and then I'll let him take it away. All right, Mark, you should see now where you can share your screen and turn on your mic.
Testing, testing.
I hear you. Can everybody hear him okay? Looks like we're getting some yeses.
Yeah.
All right, Mark, it's nice talking to you, and I see your screen now.
Thank you very much. Much appreciated, Janet.
Okay, all right, take it away. You have 1 hour.
Smashing. Hello, guys. Thank you for joining me today. My name's Mark Chapman. I'm the creator of the trademarked Trap Traders concept. I've been trading the G10 currencies since 2003. I've got some really interesting information to share with you all today, so please do stick with me. I'm just going to get stuck in and provide you with some analysis, etc., as soon as we go through a quick introduction. Light bulb moment. So essentially I had my light bulb moment that ultimately changed the way that I viewed the markets forever. I won't bore you with the details, but basically I realized that if I could learn to see where other traders were in trouble and caught in losing trades, and perhaps I could take advantage of that and losing psychology, and that would provide me with a real evergreen edge, which was forged essentially in that human weakness. So it won't ever change. Excuse me. But first, you might recognise this handsome chap. Just read quickly what he talks about, what he says about my coaching. What I like about Mark's Trap Traders course is that it really does bring the charts to life by helping you understand helping you understand the psychology behind price action. You'll be able to understand the pain underlying some price movements and discover how to go about making money when others around you are losing fortunes. That's famous hedge fund manager Lex Van Dam, who's also the creator of the BBC TV show $1 Million Traders. But first, I've got a question for you. If you could please just type in your answers in the chat window. Hands up, how many of you have ever held on to a losing trade for too long? Me. 2 hands up. Oh, for some reason I can't see the answers. For some reason I'm not seeing all the answers, but I'll just basically go with what usually is the case, and certainly what's happened to me in the past, where basically you see an awful lot of people agreeing that has occurred to them, and you know that's you're not alone, obviously, as that poll hopefully suggests, and maybe you're not alone doing that currently as well. And that's really the point I'm trying to make about this, is that bad trading behavior, that holding on to those losers, it's a human problem. It's not a strategy problem, it's not someone else's fault, it's a human frailty, it's a weakness within the human condition, and that's essentially what we're going to try and prey on. That's what we do, prey on each day. Okay. So the strategy I'm going to share with you now, this strategy alone is solely responsible for generating in excess of 2,000 pips this week in my live trade room. That's week, not month, and that's not taking multiple positions within one currency. That's one trade per currency pair, and that's also, you could have got into those trades with stops as little as 30 pips. Okay, so let me just bring up my charts. Let me know if you can, well, I can't tell if you can see my screens, but I hope you can. For some reason I don't see the responses in the chat window. All right, so there's ultimately, as you're all fully aware, there's ultimately an unlimited amount of trading strategies that exist. But fortunately, there's not too many major core disciplines that exist. Okay, it's very key to understand that. And because of that, that makes it extremely easy for us to reverse engineer those trading disciplines so that we can observe when traders take trades and actually see when they're in trouble and losing, and then we can trade against their positions. One of the major disciplines that technical traders employ is retracement trading. But first I want to talk about one of the most key elements to being able to trade traps successfully, and that's understanding the context of the context of the price action pre-trap. That's really, really important, and the reason I say this is because imagine you've got a market that sort of represents this, very sideways, very dead. Nobody cares, and part of understanding how to trade traps effectively is reverse engineering your own behavior, what you've done, because most of the time I would ask, but I can't see the responses. Most of the time people tend to have attempted one of these disciplines, or indeed all of them at some point in the trading career. In this case, trading retracements, it's about thinking about really examining the processes you went through, you go through to take those trades. And the first part to it is actually there be some directionality to the market. So if it's sideways, if it's dead, who cares, right? Nobody's interested. No one's going to get involved in that most of the time. But it's when it starts moving and it starts becoming obvious that it'll pique our interest. At that point, that's all it does. It doesn't have us entering the market usually at that moment, but it does get our interest. Then secondly, what tends to happen from there is we start to go through a process of pattern recognition. So if you are a retracement trader, or if you consider if you've done it historically, what were the steps that you went through on a chart that in terms of mentally, and then in terms of analysis, did you go through to actually come to the conclusion this was something worth some further investigation? And I suggest that it's got something to do with the following. The obviousness of the move, right? Is the angle of the move nice and steep, right? So you've got examples here where it's quite shallow and then it gets more steep as we go down. The more obvious, the better, because it'll catch people's attention. The size of these candles is important. The speed in which price prints, I'm sure some of you have experienced this before, where you actually get a visceral response when the market's screaming off in a certain direction. You actually feel compelled to do something. It actually draws you into doing something. So the more obvious, the faster price prints, the better, because that's going to draw people in to paying attention and then start to potentially taking some risk. Okay. Okay, so in this case, one of the tricks that you might want to employ for this particular trading strategy is you want to employ tools that are a staple diet of that type of trader, or if you're indeed that type of trader, whatever you use to make trading decisions at the hard rate edge in terms of entering in some type of trending price action. So just the common ones, no need to go off into the trading black hole and find all these unusual indicators and settings, etc. Just the basics, commonly used ones. So we've got a 200 moving day, a 200 period moving average, 100, 50, and a 20. Very commonly used tools. We've got stochastic, very straightforward, very basic settings. 70-30 oversold, overbought, and then we've got a MACD again, just a standard setting. So what we're essentially doing is we're realizing that people are entering the market using some variation of these major tools, and then the price action's confirming that by making a series of high highs and high lows. So imagine you were considering taking this trade. You might employ, for instance, we'll use a Fibonacci pullback tool, and another part to this would be it's very common that traders will place levels where it had been historic support, believing that in the future that's going to become resistance. It's not something I subscribe to, but the whole point of understanding this is placing yourself in the shoes of the traders who do understand this, because those are the people who we're trying to trade against ultimately. Okay, so this actually leads to the final part of the process of taking a trade. If you just imagine that you got to this point, so your MACD is below the zero line, your stochastics are heading to the 70 area, you've put in a new low, it's been making a series of lower highs, lower lows, you like this drop, it's retracing nicely into that prior level of support, all your moving averages are down and angled with good separation, and it's pinging, it's all coming together nicely in an area of confluence on the Fibonacci and on that prior level where it looks like you may have an entry here. So this is actually the final part of the process. So hopefully you can see that what we have there is a big scary, strong closing engulfing bear candle. Now, it's then about understanding who's taking trades at that point and how they entered and where they entered. So for instance, you're going to have traders that will enter the market, they'll just place orders there, and what you tend to find is not too many traders continue on just placing orders without any confirming price action, because usually that doesn't end well. And after several occasions of being sort of run over by the market, humans don't like to remain disciplined when things become awkward and painful. So what tends to happen, it's more likely, is that people go from that requirement to enter a market into a requirement for more confirmation. So people will enter as this starts to sell off. People will enter because they'll wait for a close, etc., etc. Some might need a couple of candles. The point is that this is the part that will take you in from doing nothing, from sitting on the sidelines with money in your account, to actually taking some risk. This is the coup de grace, if you like. So you've gone through the moment of just noticing that the price action's piqued your interest, it's on the move. You've then gone into the pattern recognition. So yeah, it's making a series of low lows, low highs. The MACD confirms it, the stochastics confirm it. Everything's lining up. The books, the gurus have told me that I want to be selling off this level. But if that candle doesn't sell off there, and if you just get strong bull candles continuing up, the likelihood is, that's the question if I could see the response, but the likelihood is that you wouldn't enter that trade unless you were just placing orders. And if you needed some additional confirmation, the chances are you wouldn't pull the trigger. Now that's a key point, because you're not stupid, right? If you think about why is it that so many people are using technicals and just not doing so great with them, is because at that final point of entry, it looks perfect. But you won't get drawn in unless you get some confirming price action. And I refer to that as entry cheese, because if this just continues up, you're not daft. You're not going to take those trades. Goodness knows how many people, how many people on here are multilingual, very intelligent people. What is it that keeps going wrong? And I suggest that it's basically that when you get to this point of entry, you get some confirming price action. And that's the part that gets you into the market and committing capital. Because until that point, if that just goes straight up, the likelihood is you'll never take the trade. But if you consider the game, how is it that we make money? We've ultimately got to take it. And it's not pleasant when you describe it in those terms, but that is the business. But you won't take some risk unless the price action is confirming an entry. Because that money's no good to nobody if it's just sat in your brokerage account and you're not taking any risk. You've got to go from conceptualizing it, you've got to physically move, right? Click the mouse, ring the broker in the olden days, and then you've got to take some risk. Now, at the point of taking risk, which is only, my suggestion is it only happens when that entry cheese is present, when that confirming price action presents itself, where the likelihood is the market's going to do something that is typical, it's at that point you're in the game and you're fair game essentially, because now your money's at risk. So it starts to sell off. Everyone's pretty happy. Now, this trap that I'm basically describing you to today is referred to as a structure failure trap. And a structure failure trap is really, in a trending condition, up or down, the failure of the price action to follow through as the books would suggest that it should, right? So as it pulls back, you do actually get one here. So imagine, if we go back to the hard right edge, right? This is how it would look in real time. You would have people entering here on the breakout, and maybe some momentum traders jumping in here, and then it pulls back. And now it does trap some people within that wick, but it pulls back and starts to sell off. Now, that wick would have looked as if it was selling off and potentially doing what it had done historically and making another new low. But instead of that occurring, it drags them offside. So I'm not suggesting a ton of people would enter there. If you just think about it from your own experience, who's entering at 23% fibs? Not that many people, right? But someone did, and as a consequence of that, they're being dragged offside. So that's the first structure failure. But then you're going to have people who are more patient, more disciplined. Perhaps, they've had some level of success with this type of strategy, and they wait for price to actually come back to them. They're patient, they allow the market to come to them. So they're in, starts to sell off, starts to struggle a little bit, however. Right? In real time, that would have looked like it was selling off and going to make new lows. Everything's overdone, right? Stochastics turned down. Moving averages are nice. It's bounced off the 20 period. If you put a Bollinger Band on there, that's the midpoint of the Bollinger Band, which has probably been pinged off several times. This looks okay. And then that happens. So this is where the human condition starts to fall apart. When I ask the question, how many people have held on to losers too long, this is when it starts to happen. This is when people have invested too much time into the analysis. They've got some ego in there. I really want people to understand the experience of traders who get caught on the wrong side of the market from your worst experience ever. So, oh, it's not too painful, but, think about the moment when you blew an account. Think about the moment when you took too much. You took way too much risk. Imagine someone's just got their head in their hands. They're completely freaking out. That is the best way to realize that, or to think about the people who are caught on the wrong side of these trades. And it's at this point they'll start to hemorrhage outside of their discipline. So whatever the process is, they start off with the best of intentions. Where's everyone placing the stops, right? Above that swing or above that swing. Very obvious, very common places to place stops. And this is the moment where people start to hemorrhage and say, I'll give it a bit more room. Hands up, I wish you could see, but hands up how many people have done that, right? All been there, me included, right? So this is where that starts to occur. Now, as price develops, it's wrong to think that what has occurred here is over when price is over here. That would be naive, and that would be giving the human condition far too much credit. People hold on to losers, as we've already discussed. So, what's the psychology of the people who went short in this area here for very different reasons? So you'd have had people in trades trading the breakout of that area there. You'd have had people trying to maybe jump on this a little early and trying to be greedy and get on the move, not in the fear of missing out. You've got people who went short off that level, a bit more patient. Again, momentum traders maybe getting in a little late. Just however you dress it up, there's people when price is over here are underwater and losing in this area here to varying degrees, right? But I want you to think about the worst case scenario. So think about the poor soul who sold that lot. How's life working out for them now? Okay. It goes further, the thought process of this. What about people who are making money a little bit higher up, who've maybe seen half or all of the profit vanish, right? What are these people doing as price pops up, thinking maybe this is over? Well, first of all, they're uncertain. That's a definite. Have you ever been in that situation where you maybe had 200, 300, 400 pips, and then you kind of held on because it was trending, then all of a sudden you got half that or a third of it remaining? Your shoulders have dropped a bit. You're not as excited as you were down here. You actually banked that money psychologically down here, but unfortunately for you, price is now over here, so you're uncertain. Maybe you're taking some profit. Right? The white flag's up and you start taking some profit. Now, if you are to start exiting that position taking profit, and you were a seller up in here, you've got to buy to exit. So this is quite a commonly understood phenomenon if you're trading futures, stocks, etc. But it's not so clear in Forex, where the vast majority of brokers just have a close button. So it's hard for people to understand the order flow because it just says close, right? But the reality is, whatever direction you take that trade in, the opposite is true for first of all, being stopped out. So if you were selling off that level and price does go up and you adhere to your stop, what transactions occur in there? It's buying, demand. The same is true if you automatically you just manually take yourself out of the market, or you take some profit. It's the opposite of the transaction that you took. So net, this is creating demand for very different reasons, but it's creating demand. People are exiting, people are being stopped out at these swings, people are taking profit. The point is, there's a psychological edge at the bottom end of this move where these people are losing, and it can't be described any other way other than to say if people are still in those trades. And remember, humans have the propensity to not like to do things when discipline's involved, right? It's easier not to go for the run out when it's freezing and raining outside. You shouldn't eat the cream cake, but you do, right? Smoking, bad for you, you like the cigarette. Those things are easier to do than go through the discipline of not doing them. And this is why this occurs. So at this point, the edge is, well, if you could put it this way, if you could offer these traders who are losing in this area here, if you could offer them to take their pain away, right? They're held on to these positions, cancelled stops. The world's a very awful place for them at this point here. It's the point of maximum pain that they've experienced in that trade. If you could give them a deal, a wager to get out of that position, but they had to take another trade. They couldn't just walk off. You'll take the pain away, but what they've got to take another trade. I would suggest that many people would take a buy. And what I'm saying is that essentially an edge has presented itself. It wasn't in here, but it's here now. And it's to the upside. So what we want to do is we want prices to pull back a little bit. Again, walk through the psychology of what's happening here. If you think about the person who sold the low, they're looking for any sign of a turnaround. So maybe, you could say that there's a level of resistance, maybe, right? Historical support. They just, yeah, it's gone through a bit, but maybe it's coming back, right? There's a moment, a glimmer of light relief, some hope. And then it goes again. Oh, Jesus, this might be a pullback, and this could be, shallow pullback and going against me again, under the cosh again. But then it starts to sell off, right? Maybe I'll get out of this after all, right? And you've got to think about the people that you're trading against. You've got to walk through the scenario, which is easy done when you put yourself in their shoes from experiences we've all had and some are unfortunately still having. So at this point, basically, what we want to happen is the price to pull back a decent amount and allow us an opportunity to get long. What I prefer is it not to return all the way back to this area here, because the reason for that is it allows these people off the hook, and I don't want them off the hook. As unpleasant as that sounds, I want to squeeze them while they're getting squeezed financially, emotionally. I want them to be in a weak position when I pull the trigger, and I will not enter the market unless that is present. It's not, as I say, it's not very polite, and I'm very sorry about that. If you want to go off and do wonderful things with the money you earn after you've done it, fantastic. You'll save the spotted owl or whatever. But while you're in the markets, unfortunately, it's brutal. And when I enter, I have to have that present because I have an edge at that point. And when the edge is present, it doesn't mean you make money 100% of the time. But when the edge is present, you must act. Take the trade, the outcome's the outcome, and you move on to the next independent event. And we do that only when people are losing under pressure. And just think of the worst case scenario. We want that to remain present when we pull the trigger. So there is a second entry, and that is it would come back into this area completely. Now, why do I say that that's an entry? Well, think of the order flow. If you consider somebody's gone through that scenario, right? So they've sold off what looked like a perfect entry, and now they've been through this entire nightmare. What's the trader who sold in here? What's their psychology like in terms of their expectations about this trade? Are they interested in making money at this point? Or perhaps they are more interested in getting out of this alive, right? Maybe the summer holiday money's on the line and they just cannot believe the situation they've found themselves in. They've cancelled stops, they've took too much risk, they're holding on to a loser, right? That human frailty, that human weakness. They aren't thinking about money anymore. They were here, they're not here. They're thinking about, can I get out of this alive? So when price comes back in, should it come back into there, what is going to happen is they're going to exit those positions en masse. So that's going to create demand, because if you sell, you must buy to exit. And scratch trade would be their number one trade of choice, outcome of choice at that moment. That makes sense? So that's going to create demand there. Now, you might have then what would look like maybe a double, triple bottom at that point. So you're going to have level traders who, by the way, I can't say comments, I do apologize, but one thing that might be labeled at me because price is trending like that is, you're an idiot to trade against the trend. In actuality, we don't trade against the trend. We're trading against people trading technical trends against the fundamental bias. So when we see this, but fundamentally we know, for instance, the pound's stronger than the Japanese yen, right? This has just been a risk-off environment where the safe haven currencies gain strength, right? Oil, this is just, I'm just using this as an example, but fear, it strengthens, but fundamentally it's not stronger. So what we're looking for is traders technically making those mistakes, taking trades against that fundamental bias, even though from a technical perspective it may look like it's trending. So I just want to make that point. So when this pulls back into this area, you might get you might get fundamental traders who are trading technically to enter the market who start buying in here. So what's that going to obviously create, right? More demand. We would buy there too, demand, etc., etc. So this could be an inverted head and shoulders, whatever. But the point I'm trying to make is that there's a second opportunity. I prefer it not to pull back all the way. As I say, I prefer to have them well and truly on the hook. But should it come back, there is an opportunity to go along there as well. So the entry is as follows. I don't like buying it and selling at the market, so a little pullback like that would be no good to me. What we want is just a decent pullback, 38, 50%. So long as though it doesn't come back into this area if possible. And it's a 2-candle entry trigger. And it basically he's the entry here. And what we're looking for is one candle closing in the direction that we want to go, and then the second candle, what it has to do is it has to go down first and then back to the open, and then those bids actually firm up. So what I mean is I don't want it to go up and just go long at that point, because those bids might vanish and it could reverse to the open or worse, sell off. What we're trying to do is time the fact that candles flip bullish from the from the open, bullish and bearish. Now obviously that occurs a lot less on the high time compressions. On the lower downs, the tick charts, the minutes, it's crazy, it'll just flip up and down. But on the higher ups, it doesn't happen as much, and what that does is it actually creates a trap, first of all, for people getting this wrong, and then it allows us to try and time the entry a little bit. I got into quite a lively debate with a gentleman who was a former banker at Citibank in London. And he said, when I said that candlesticks or candles or any way you look at price act as traps, he thought that that was taking my ideas a little bit too far. But let me just give you a quick example of that. You see this candle here in real time? Right? In real time, that would have looked extraordinarily bullish, right? I'm not saying it's a great location, but in real time, that's bullish. Very green, very positive, heading higher. What if you were the person who bought that high? How are you feeling about not being trapped at that close? And I think that's fairly, you'll find that you're in a fairly trapped situation there. So candles, in my opinion, do act as traps, and that's what we're trying to basically avoid it happening to us. So the other thing to notice as well is you want to look at the structure as well. Is this a fractal swing structure? So do you have a low surrounded by a couple of higher lows? If you do, and this pulls back first, then if it pulls back to, say, this region, I know it didn't do it a great deal there, but imagine it was a little deeper. If it then travels all the way up and then back to the open and turns bullish, there's a good chance that swing structure's been put in already. So that makes for it adds to the chances of this being a profitable outcome quickly. That's the reason why we're trying to do this. In terms of stops, you can stick it below the entry trigger if you're super tight with your risk management, or you can go below the swing structure itself. By all means, you can go below the traps as well if you wish. In the end, it's just a function of risk. You do what you want with that, and I encourage, obviously, you always are attempting to go for 2 times upside relative to what it is that you risked. And there we go. So that's basically what I refer to as a structure failure trap. And the key is to make sure that it seemed like a dream trend entry. And the key part to it, the final part to it that makes people take risk, is when you get that confirming price action. Without that, if that just starts going up, no one takes it. Like, as I say, people aren't stupid, but the will at the hard rate edge, for whatever reason, people get focused in on it and they don't realize that that big void that we all have, right, this is the hard rate edge, this thing's going to fill. It just requires a bit of price, it just requires some time, and obviously the price will fill it. But for whatever reason, we fail to consider that many times, and as we enter, then we're in trouble. And now at that point, the human frailty element kicks in, and now the edge is present. Okay, so we're going to look at this. On another example, this is the dollar yen. These are current charts. These are trades that we're in. These are part of the 2,000 pips that we made this week alone. For those who don't trade Forex, stocks, options, futures, this will work. If there's people involved, then this will work. It's about that confirming price action, that pattern recognition. And if you see it and then you see price going against them, then you know you've got something. So again, right, context pre-trap, the market is heading down. And for us, we know fundamentally this isn't the case. Bit of risk on at risk off at that moment for sure, but fundamentally not a wise move. So technically though, looks fantastic. So your technical trader sticks a fib on there. Maybe there's some localized historical support, becomes resistance. Not that clear there, but you get the idea. Moving averages, trend lines, you name it. Your stochastics are overdone. As it pulls back up, starts to sell off. That's your confirming price action. That's your entry cheese, right? The cheese that tempts the traders in. To varying degrees, they enter, whether they need it to close, whether it's taken out a prior candle as low, whether they put an order in, etc., etc. That gets them in. If that just keeps going up, no one goes in. That makes them commit risk, and at that moment, the fair game. So price doesn't sell off. but then struggles to close above the 61, and up it goes. Now there's an edge present. Every single person who went short there, and anybody who's still short from those positions, is now currently massively underwater. And that's the way I want you to think about this, that they are hugely underwater and in a massive amount of pain. Then we're looking for the 2 candle entry. We get 1 candle in the sequence. And it's also worth to know that that candle wants to be, you know, seriously bullish if possible. This one's obviously engulfing. It's an outside candle trap in and of itself, so it sold off first, took out the low of the prior candle, then reverses, closes near its highs and takes out the high of several candles in fact. So this in itself is a trap, and this in itself is a strong candle sequence, which is something to be aware of as well. And then you get your second candle entry. And up it goes. So we're only entering the market when traders who take these common technical entries, in this case the discipline that we're trying to prey on is retracement traders. Making that mistake that they just don't see coming at the hard rate edge, and then once their psychology is that they're losing, getting squeezed, the human frailty aspect, etc. is in play, then we have an edge. It's time to enter the market and go low. Okay. So if anybody would be, if I've at all interested you, piqued your interest in terms of this trading methodology, I hope I have. For those who aren't interested, I wish you well in your trading endeavours. But if you would like to get involved, basically the offer is today instantly get access to a course where IX lavishly broken versus one that's just a stop hunt. Now this is huge because, as I'm sure you're aware, you know, breakout trading looks like the most amazing strategy, where if you were to only be able to select the breakout that makes all the money, right, that when the market actually does get on its bike and travel somewhere. The problem is it fakes you out 7 or 8 times before it does that. Now I can tell you, and that information will show you precisely the difference. And when used in conjunction with traps, you have yourself an extremely powerful methodology. Usually that sells for $197, and then because you went for that, the special today is 30 days in my Trap Traders live trade room. For the last 30 days we've probably done in and around 3,500 pips. That's not an exaggeration, that's a reality. And by the way, that's using the strategy I've just shared with you. Usually that's $97, value $297. Today your investment's only $47. Now I would take questions, but for some reason I can't see the questions, so I don't know if there's a way of the guys handing back to the guys and maybe them putting questions to me. But thank you very much for your attention. I hope you've enjoyed that, and I've given you some insights that perhaps you hadn't previously had. Hey Janet, are you there?
Hey Mark, I'm here.
Hi, yes, sorry. Yeah, really apologise to everybody. I can't see the chat window at all.
I'm here. I can help you. Hang on a second.
Okay, thank you.
Let's take some questions for you. So,
Okie dokie, go for it.
just have to wait for a second. And Silas was texting me. He said, "You gotta come back."
Come back.
Excuse me, I've got very bad.
No problem.
Let's see. Let me scroll for a second. Hopium. Somebody called trading when you stick around too long. Hopium. Sure. One of the questions says Fibonacci. Did you see that question? Do you use Fibonacci?
I'm actually using Fibonacci against the Fibonacci trader. Okay, so essentially what we're doing is we're trading against people using those common tools to enter trend trading markets. We're waiting for that entry cheese, that confirming price action is the key part, because without it you won't enter. And using the fib in the opposite way actually provides you with that insight as to where people are likely to enter. So example, in the chart I shared initially, you'll have noticed that it bounced, it broke through that historical support, comes back into resistance, right, where they believe that resistance is. I don't buy that, but that's what people trading those technical strategies believe. It starts to sell off. That's also the 61, right, the 50% fib, the commonly used fibs, and that's how you know people are taking trades. Without that part to it, we can't be certain. So the fib acts as a brilliant tool, not on its own, but as a package of ideas that show us where people enter. And if we know where they enter, it follows that we know where they're trapped. But what we do differently to those people, and it is pathetically simple, is we wait. That's all we do differently. We're passive. We watch them. We observe where we think they enter, and then let price. We don't move the market, so let that process occur, and be certain. The reason why the support resistance course is so important is we know the difference between a level of support and resistance that's gone and one that's held. And I'm not talking about a close above, and I'm not talking about a certain distance. I can tell you that some levels break hundreds of pips and they haven't broken, and this information will tell you that. But by any standards, by any explanation of it, by any book or guru, will tell you that's gone. And I promise you there's a process of knowing from A to B the difference. And when we couple that with that trap element at a Fibonacci level, we then know the market's on the move. Then we know those people are in trouble, then we enter. I hope that answers your question.
Okay, all right. Someone's asking, do you trade in 4-hour charts only? For example, long-term trader.
Yeah, I'm not a long-term trader. We have. I know when people look at 4 hours and daily charts and things, they automatically think that you're not a day trader in some sense. But we've probably taken 10 trades this week, maybe something like that. Now I appreciate that's not the level of maybe somebody attempting to scalp, but it's fairly active. And because we hold positions and we're going for many times risk, we're going for hundreds and hundreds of pips, then we're always managing trades. There's always something happening. It's about being profitable. It's not about being active. And for me, I've yet to find a scalping type trader who's made a ton of money, because as retail traders we're disadvantaged. We don't have the technology. We don't have the deals with the brokers and the institutions, because we don't have the money. The technology in terms of connectivity can be slow. It's stacked against us. And then the final part is when you go down onto those lower compressions, it's very difficult to remain focused. Whereas if you go higher up a little bit, you ignore the noise, you start stacking the odds in your favour a little bit. When I was taught to trade, the gentleman who taught me was a former banker at JP Morgan, and he used this phrase. It's always stuck with us because he banged it into us, and that's: trading success is good reward over risk plus the elevation in probability of achieving that reward over risk. And the key point is the elevation. And an elevation for me would be come out of the shorter time stuff and go up to the higher time stuff, because it's a lot easier to analyze, and you can be very profitable up there. But don't mistake it for being boring and inactive, because it honestly is not.
Okay, back to the fib thing. Is there a way for you to demo that on a chart? Can you put a chart up and show them how you use it?
Do it again? Yeah, okay, yeah, 1 sec. Yeah. I'm just going to drag it across again, guys, so 2 seconds. So, in the example of the, we'll go back to this example. So, we're just using it as, oh yeah, go on.
One of the questions for your offer link. You could drag the chart down. Can you drag the chart down just a little bit so they can see the link? I don't remember where it was.
Okay. I could probably go. There you go.
I'll type in the chat box for people too.
Thank you.
You can drag it down just a little bit, just where they can see the actual URL.
Okay. The price is cheap. You don't need to look at the price. by the way, the trade room, maybe just before while I'm doing this, the trade room, everything's recorded. There's hours and hours of content. There's a live chat. There's research that I provide every day for risk on, risk off, fundamental analysis. The lot we do a great deal. It's not just we're not just trap traders. We have a very in-depth process that we go through. All right, so let me just get rid of some of these windows. Right. What we're essentially doing is we're trying to use these tools against people who use them. That's basically it. So in the scenario, it's about the context pre-trap. You've got to. It's got to be going somewhere. It's got to be obvious, because if it's not, no one cares, right? Who cares? No one takes trades. So when it's obvious, we then start to recognize the patterns. So in this case, it's making a series of low highs, low lows, right? It's a trend. In this scenario at the end, it takes out that prior low and makes a new high. Makes a new low, getting confused. Makes a new low, you put a fib on that most recent swing, right? And at that point, you're just measuring where they would likely enter the market. So the 50, the 61 is the common one. As chance would have it, this coincides with this historical support. It's not necessarily support for me. It could just be more likely is profit taking. A level for me needs to be touched a couple of times before you could say that. But that's what they think. So it doesn't matter. I'm just trying to reverse engineer their behavior, because it's just aesthetically pleasing. There's no reason why there should be resistance or selling there, supply there. But people jump in anyway, and it's that's how we use it, right? And then when price develops, it may not happen in this scenario, but it's about just waiting and watching and waiting for when it occurs. So now we know it's likely that those fib traders went short in here are now in trouble. So that's how we use a fib. We're using it against them. Now, could you use a fib to enter? Yeah, of course you can. If that's what you know, there's no reason why you can't, but it's it's not the end of the world if you do. We're trading human psychology. They're losing behavior, right? I didn't see the numbers, but usually when I ask that question, more or less 100% of people say they hang on to the losers too long. So that's what we're preying on. We're preying on the fact that people are in here losing money, and as that comes back, they're still on the cosh. And then we jump in as their misery is compounded. So if you want to use a fib, by all means. But really, I'm more bothered about the 2-candle entry trigger. Wherever that happens, and I'm in, providing everything else is equal and in play.
Okay, perfect. Do you use market correlation at all?
Yeah, we do. We're watching the stock market, the bond market. We're watching sentiment pre sessions. I do the groundwork for people. I do that and post that in the notifications tab. So I do all the grunt work for you, and I tell you whether or not risk is on and risk is off, and how we use that information. With the day frequencies, if the stock market's flying, day things aren't doing so well. So else if it's flying right, bonds are doing well, etc. So we're looking for those relationships, and then if, for instance, the stock market's flying when this is occurring, and then the stock market starts to pull back and then starts to fly, we're using it to confirm our entry. So everything is in sync. This is not just a one-dimensional approach in any shape, way, or form. We're using that. We're going against commodity currencies. We've got a whole range of tactics we use every day, and I set the stage and tell you which direction we should be trading and why.
Okay, perfect. All right, Mark, do you trade futures at all outside of currencies?
I don't, but honestly and truthfully, I know I can't say this 100%, but it's the same. If humans are involved, it's the same. If you can spot that pattern, right, that pattern on a futures chart, and then that occurs, you have an edge. Take the trade. Whether that's futures, this will work in options, right? If someone places an option, this isn't going to come back. That's not a bad way to take some options. So. But it would work in those other markets. The human cycles we're praying against. Not only that, it's the human disposition. Just think about when people are super disciplined, they stand out like a sore thumb. For the most part, we're not. In any aspect in life, and made worse in trading because there's money, emotions, took too much risk, not really sure what you're doing, etc., etc., etc.
Okay, perfect. And I'd say that's a perfect answer because for me, I'm a futures person. So I grew up trading futures, and that's the market I know. But if someone would ask me, she worked on trading the bond market, I was that day and time when I got asked that question a lot. Bonds were always inverse to what the S&P was doing. So I would say, okay, well, if I'm long, then, and you're a bond trader, then use the S&P, the NASDAQ, the Dow, use those major indexes to tell you if they're up. And on a typical day, bonds should be going lower, so short. So it's just the idea, the psychology of
Absolutely.
works I'll be answer it for some people, but what time do you operate that trade room? Like what days, what time, and then what would you just give a brief overview of what people are going to get in that 30 days?
Yeah, so in 30 days, so what you're going to get is you're going to get, gone blank now, so what you're going to get is 5 days, right? It's every single day. I'm present, I'm running the room every single day. It's a lovely, friendly environment for those, people who are not that way. I'll just give you a refund. We want it to be a really positive environment. It's not moderated. I answer every single question anyone puts to me. If I don't know the answer, I'll find out. I don't know everything. I do know a bit about trading traps. So it's a very open and friendly environment that's not closed off. We take trades together. There's probably over 32, 34 hours worth of coaching available within those trade room recordings. So when I start a session, we look at what's happening, and we form an opinions and what events that are coming up. We discuss all of that, and then I go into really teaching trading traps. Because the purpose of what I'm trying to do is to share my philosophy. I don't want people to come in and just like take signals and stuff. I'll give you signals, and we do really well with the signals, but my sole purpose is to teach you how to do it yourself, so that when you leave, it's a big subject, but it's not hard. Like, I'm dyslexic, I'm not the cleverest person in the world, so if I can do this, so can you. And because things have to be explained in terms to me to get it right, then I deliver it in simple terms. So you're going to get a live chat, you're going to get 30 plus hours of coaching and recordings, you're going to get that sentiment grunt work that I do every day, you're going to get fundamental bias, my business cycle analysis, my central bank analysis, you name it. You're going to get it whether or not risk is on, risk is off, entries, stops, targets, trades, everything.
What time of day is that? And can you equate it to Eastern? They're asking about time.
It's 12 GMT, 12 p.m. GMT. Lasts about an hour or two, so that's like 7 Eastern, isn't it? Something like that.
Okay.
7
right, so there's your answer, Moj. 7 Eastern. Okay. Do you, what's else? Okay, here's a good question about trading the market right now. William says he's short the yen against the dollar. How do you see this pair in the future?
It's a good question.
Well, if you knew that, we'd all just do it, right? For sure.
The thing is, what I try and do is we work really hard in trade selection. So, for instance, I don't want to be short in the dollar because fundamentally it's the best. It's the dog with the least amount of fleas. We've just raised interest rates, although it's tentative in terms of how many times the Fed will raise rates. They have raised rates, and even after the FOMC the other day, there wasn't. It was what they didn't say, but they didn't say they're not going to do it in March, although they'll be pushed to do so. So the dollar, in my opinion, in currency land, is extremely strong. Now, what you have in your favour, potentially, is China, is oil, right? But unfortunately, what's happened is that risk-off environment has kind of turned to risk on a little bit. And one of the main benefactors of that would be the dollar. So you may... I hate to talk about it in these terms because you're in a situation where maybe I don't know whether you've took too much risk, whether you can take the loss and move on and it not negatively impact you. It's hard to say, but for me, For me, I'd kill the trade. I'd wait for it to pull back a little bit, and I'd get out of that particular trade if it were me. But I can't advise you, and I just, I can only say those comments really. But for anyone more broadly, like I think everyone should trade. I think the world should be trading. So it's like, and the reason for that is I think that I'm an advocate for low risk trading. I'm like negative leverage, guys. Right? Don't let this business ruin the life of you and your family negatively. Just come in, get some education, see if you can do it. Hopefully you can. If you can't, you move on with your life and no one's worse off for the experience. Probably it's enlightened the conversation around the dinner table, but don't let it negatively impact your life. Just don't take much risk. And I'm huge on that because that'll allow you to reduce the impact of negative psychology on your own performance. You won't get as bent out of shape if you realise that you've got to be taking 100 trades before you're anywhere near profitable. The outcome of one trade is random, but the profit is when you take those consecutive trades and you're able to go through those drawdowns and not be negatively impact you because you haven't took too much risk. It just helps you to remain in the process, keep going forwards so you don't fall victim to what we're essentially trying to prey on in the room.
Okay, I'm going to take one more question, but I want to remind everybody I'm getting this question and I'm just looking at your offer. You guys that are asking about the recurring charge, it looks like if you go to their order page, it explains exactly what you're getting.
Yes,
so if you go to forextradersdaily.com/thirsty, you'll see that they're going to give you his course on trading concepts. They're going to give you 30 days access to his room and all that for $47. And then after the fact, if you stick around in the room, you'll get charged $97 a month. And if you want to stick around, great. If you don't, just email them at info@forextradersdaily.com. And I just texted Dustin because somebody was asking me how to reach them privately, and I got that to y'all. So okay, so the last question we're going to take because we've got about 4 minutes left, and I'm going to let you wrap up. And y'all, if you didn't get your question answered, email Mark at info@forextradersdaily.com and he'll get it to you. But I'm looking at this order page, and they're only leaving this offer up for another 23 hours. So after that, you'll have to go pay full price somewhere else. And I'm not a full price kind of girl. So this question's been asked a bunch. So how much money would you recommend? So if somebody was just playing with a little bit of house money, they weren't necessarily recommending you playing with their mortgage or their kids' college tuition. How much money would you say is enough to trade this strategy?
To trade this strategy, you can do it with a few $100s. Absolutely. As I said, those trades that we've taken at the start of the week, the stops were you could have took them with 30 pip stops. And that particular trade that I just had up a minute ago is currently sitting somewhere in the vicinity, well, it had been up 300 odd pips, and the other one had been up 580, something like that. And that's taking time. I'm not exaggerating. The stop point, the stop could be just below the entry trigger right there. So you can do it with a few $100s, and that's the other part to this as well. The world is absolutely brimming with capital. It's not so full of good traders. If you become one, just doing it with a bit of pin money, you can attract capital if that's what you want to do. And then again, it reduces the impact on your potential for ruining, having a bad day and ruining your life because you took too much risk.
I totally agree with that. I mean, everything you said today makes perfect sense to me. I'm not real versed in trading Forex, even though I've been around it for a long time, more so on the just the straight currency side, not the pairs. But this common theme is, like you said, when people go, well, can I use it with her futures? Can I use it for stocks? Heck yeah, you can. It's just learning where the tops and the bottoms are, figuring out how to calculate the support and resistance accurately, and then watch it play out. So I've really enjoyed listening to you today, and I'm sorry you weren't able to see the questions, but it's
okay. It's probably something I'm doing wrong.
No, it's no big deal, though. I'm glad I was here. Sorry it took me just a second to come back. All right, once again, guys, it's forextradersdaily.com/thirsty. I'm going to personally thank Mr. Mark Chapman for coming and joining us today. It's his first time here at Trade Thirsty, and he will definitely, no doubt, be